What is up? What's going on, everybody? In 2025, guess what? Real estate investors handed over $1 trillion in transactions while paying almost zero capital gains tax. That's right, zero capital gains tax. They aren't breaking the law. They're just using a 1031 exchange to swap active headaches for passive wealth. Today, I'm going to show you guys how they actually do this in today's Deal Makers Club. So, thank you guys for tuning in today. We're going to dive right in and really help you gain a better understanding of 1031 exchanges and Delaware Statutory Trusts. But one of the things, now that we're retiring from the Air Force and now operating as a financial advisor, and with everything that we do with REI Genius, that we serve real estate investors that are looking to exit active income and build passive wealth. And so one of the ways that we help clients get rid of the tenants, the toilets, and the trash. They get burned out. They're ready to retire to be hands-off real estate investors, diversify their wealth, and everything that we do and build is centered around serving those clients in that space. So here, and I'm going to share kind of this document with you guys today, and really go through and educate you on one, what is a 1031 exchange? Really, when you think about it, a 1031 exchange, it isn't just a tax rule. It's a capital mobilizing machine that hands roughly $1 trillion in transactions annually. It's no deal. It's no secret that the wealthy understand the tools in the IRS tax code on how to navigate the exchanges. It's named after Section 1031 of the U.S. tax code, and it allows real estate owners to sell a property and reinvest the proceeds into a like-kind property while deferring capital gains. So the big thing with it, you keep your equity working. So many times when you think about it, you lose 20, 30% of your profit that goes to the IRS if you do a traditional sale. So this allows you to keep your equity working. When you look at the 1031 exchange, the number one thing with it, you're deferring taxes, which allows you to keep that 20 to 30% that you were paying taxes. Is working for you still, gaining profit, continuing to the velocity of money where you're still earning a return on it. So taxes are deferred, not forgiven, which means more of your equity stays invested in your portfolio than being lost to the IRS immediately. You can grow that money. Then there's strategies on how to exit when you finally get to 10, 20, 30 years, you're done investing in real estate, you want to step down from active management and retire. There are other mechanisms you can use in order to defer those taxes and continue to reap the benefits of all your hard work over the last few years, the decades that you built up your wealth and the like kind of standard. The thing with the 1031 exchange, that one of the nuances with that is the replacement property must also be held for investment purposes. But the big thing when you look at the data and diving in 2025 alone, you had almost 1/3 of all single family home purchases, the highest in the last 5 years, overall sales that were due to persistent and reduction in interest rates. And when you look at that when you look at real estate investors and how much of the activity that we know with high interest rates, that the normal buyer for a family hasn't been purchasing homes. Right now, the first time home buyer age is around 40 years old. I'm going to say that again. The first time home buyer age in the United States is roughly 40 years old. So if you come out of college 23 years old, it's going to take you 17 years of saving and investing before you can own your own home. And so that's just been a run up for over the last 3, 4 years with appreciation of real estate due to inflation and printing of a lot of money, but then also higher interest rates right now with the Federal Reserve raising rates and the 10-year Treasury notes where we are today. And so with those things, a lot of families have been on the sideline and real estate investors have been stepping in to the tune of 33% right now in 2025 purchase real estate. So meanwhile, when you look at the 1031 exchanges, for as how investors tax efficiently buy real estate, over $1 trillion in annual transaction volume, a lot of transactions that are happening. And so the thing today is understanding what does that mean for you when it comes to a real estate investor and building wealth and how you can level up your portfolio and continue to grow along the way. And so really kind of diving into the golden rules, when we start looking at 1031s, that the golden rule is 45 and 180 days. In the 1031 exchange, the IRS is the world's strictest timekeeper. Like they don't play. If you bust the time window, oh well, pay us our 20, 30%, however much you owe of your capital gains to go. And so you don't want to miss the deadline. And so one of the things, the middleman is, and I would say for a good reason, the qualified intermediary, they are all created equal. So there's some good ones, there's some bad ones, there's horror stories where people bust timelines because they're QI, what they're known for, or known by, as an acronym. They aren't that good sometimes. That you have good ones and bad ones. And so the big thing is you want to have referrals. You want to do your due diligence on who you're working with to make sure things don't happen where you bust your 45-day window. But the 45-day identification rule is from day that you sell the property, you have 45 days to formally identify potential replacement properties in writing. And you have to document this, and you have to notify the IRS that, hey, these are the 3 properties, or, if you want to look at the 200% rule and like, hey, these are the properties that I want to identify, that I want to purchase with the proceeds from this sale that I just happened. And oh, by the way, you aren't able to take the proceeds from that sale. And so that's where the QI, the qualified intermediary, comes in, where they actually take receipt of the distribution from closing, that capital that's moved over to them, and they're the custodian essentially of those funds, where you never take receipt of the capital. Or guess what? You just blow in your exchange and you take the money yourself. So definitely understanding those nuances are extremely important. And then after you identify the 45-day window, there's a 180-day completion rule. So you must complete the purchase of this replacement property within 180 calendar days of your sale. So not 180 days from when you identify in the 45-day window. Everything is based off the date of your sale, when you sold your last property, and those gains that you're looking to defer, you want to be able to move those into your next property within 180 days. And then the value requirement. There's requirements, of course, that to fully defer the taxes, your replacement property must be equal or greater value than the one you sold. And so when you start looking at the boot, and that's another discussion, another day, but really diving in on where you have to look at the level of debt that you had on the property. And when you look at the new property that you're buying, that there has to be that same level of debt included in that property. And so there's some nuances that you want to go through. And that's why it's extremely important to have that qualified intermediary on your team, and really talking to these people up front. Those are some of the conversations that I had with QIs is, a lot of times in 1031 investors come in, they're panicked. They haven't done it before. They're afraid of the timelines, and they feel under the gun, especially if they haven't planned up front. And so that's one of the things that we love to sit down with clients and understand what are their needs, what are their goals, what their time frame for selling, if they're already in the window, and really helping them build out a plan that's strategically aligned for their long-term goals. Because most of the time you're looking in that 45-day window, you could be panicked because guess what? Now you're beholden what's available on the market. What can your broker find? And if you don't have a plan set up, you could really be stuck looking to acquire a bad property that doesn't meet your long-term goals. And that's why I love meeting with clients that are looking to exit real estate, or they're looking to execute a 1031 exchange, but they want to know, hey, what other options are there outside of just buying another property? And that's where we come in with some of the opportunities with Delaware Statutory Trust. And so you may be asking yourself, what is a Delaware Statutory Trust? And essentially it goes by DST, but it allows you can own a piece of $100 million apartment complex. I wrote an article in my newsletter last week that was talking about the, I think it was $325 million acquisition of a San Jose apartment complex that was built a couple years ago. And I think it had somewhere around 500 units in the apartment, but average rent out there is like $3,500 a unit. But you as an owner with a Delaware Statutory Trust can actually own a piece of $100 million apartment complex or a massive distribution center instead of a single family rental, or buying a value add 10 unit apartment in a crime zone in a D or F class, area. And you're struggling with managing from California, and you're buying a property in the wrong side of town in Atlanta. And you're trying to, just because you had to, you were forced because of this 45-day window, that what we're seeing a lot of individuals look at, they're looking to better understand Delaware Statutory Trust. And it allows you to come in. One, you have fractional ownership. You're owning the real estate. And so you can partner and invest in institutional deals right alongside other investors. And you have operators that manage, could be billions of dollars of real estate, that have institutional management and experience, that are managing this asset and you have a fractional ownership. And so a DST is simply it's a legal structure where multiple investors own beneficial interests in large, professionally managed institutional quality properties. And they're compatible with 1031s. And so the DST interest qualifies replacement property for the 1031 exchange, making them a popular exit strategy for the landlords. My tired landlords out there, if you're done, you want to be done active managing, you want to be done with the tenants, the toilets, the trash, some people say the termites, but really you want to have less headache and you want to have more time freedom. I know for me, being a value add investor, I started in fix and flips, then started buying apartment complexes, that being a one-man show and managing the apartment complex, the renovations, working with the contractors, managing the property management, that, it's a great strategy with value add. You're able to force appreciation, but it does take work and it does take time and it does take mental capacity. And for a lot of investors, once you reach that point that you're looking to bring back that time freedom, maybe spend time with family, step down and just relax, that you're looking for something that's more institutional. You don't have to worry about phone calls. You don't have to worry about the distributions and things like that and collecting rent. And so for that, DST's interest, they qualify as a replacement property for 1031 exchanges, making them a popular exit strategy for those tired landlords. And I have the conversations and people are really looking and understanding what's out here. What options do I have? Is it really feasible? I can defer my taxes and move into something that's passive that I don't have to worry about managing the operators. And the thing is, these trusts, they often invest in assets, an individual couldn't buy, alone. And so when you start talking about medical offices, logistics facilities, large multifamily communities, assisted living facilities, senior living. Also, you can see opportunities around student housing where you may have one DST that owns 3 student housing projects in different Division I type of schools across the U.S. in different areas. And so now you're diversified geographically, you're diversified from different asset classes within real estate. And, at the same time, there's also, I forgot to mention, you have triple net leases out there for retail. More when you start thinking about investing in Dollar Generals. Have you ever seen a Dollar General just close? Or, when you start looking at tractor operations, and another one that we see right now, Hobby Lobby, CVS's. And so a lot of these leases that you have 15 years, and you're in the DST that's looking to own this for 5 years, but you have a 15-year remaining lease from a national corporate chain. And so there's a lot of opportunities out there that you can study and understanding, what type of institutional assets do you want to look at and how do you want to build a diversified portfolio with that. But I think when you really look at it, why investors really look at in choosing DSTs and what are the benefits of a DST? Many investors, and I kind of alluded to it, but they reached a point where they want the income from real estate without dealing with all the stress that comes with active management. When we talk about the 3 T's, the tenants, the trash, the toilets, and they really want the other T, truly passive income. And the thing that comes with investing in DSTs and looking at that and having that as a strategy, that investors receive potential monthly distributions, but have zero responsibility for the maintenance, the operations, and the tenant management. Because I can tell you, once you're leasing up, you're running applications, you're having conversations with tenants. It can be a lot. And then if you're still having a W-2 job and you're looking to work with another business or, spending time with family and really relax, it's hard. It becomes a challenge. The other thing is really the portfolio diversification. Instead of putting all your proceeds in one local building, and we talked about that, you have to buy, you're forced to buy the one lone apartment that's still left in the market, in your market, that you want to be close to manage, and you have to buy a crappy deal because you're on a 45-day window and there's nothing on the market that you can buy. And so the DST allows you to spread capital across different asset classes, across different geographical areas where you're diversified, and you don't have to worry about, having all of your wealth isolated in one single asset. And then the ease of closing. Because DSTs are kind of pre-packaged, they often can be closed in 3 to 5 days, which takes the stress out of the IRS's 45-day identification window and then trying to close after, that it can be a straightforward process if you build out your strategy that I help you guys out with, and really look at having that strategy and then looking at what's out there on the landscape and then moving out in building out a suitable plan for you based off what your goals are. So, that all sounds good, but is it too good to be true? So, what are the critical trade offs and risks that come with DSTs? So I'll tell you, no investment is a sure thing. And before you jump into a DST, you have to understand what you're giving up. And really, it comes down to control and liquidity. So, jumping on the money side, illiquidity. So, DSTs are long term commitments, often with 5 to 10 year holding periods, and you can't easily sell your interest if you need cash tomorrow. So, that's something you definitely have to plan for. You want to make sure that you have enough liquid assets, and this isn't a large portion of your wealth that you're putting away that you can't access. But there are opportunities as well. There are some DSTs that have a proposed shelf life or time frame of holding of only 2 years. So there's different opportunities to look at, but you want to look at your long-term commitments and make sure that the investments that you're making and the strategy that you have, that it aligns with your long-term goals. And that's why having an advisor, and that's why having a really good understanding of your holistic plan and not just chasing a deal where you're on the 45-day window, but you don't have a strategy on how you're going to build wealth, on your full estate plan, on how this is going to align 5, 10 years down the road. You're just grabbing whatever deals on the market that you can close on. And it may be a horrible opportunity with a lot of risk that you're taking on unnecessarily. And so the next trade-off really is looking at you have zero control with DSTs. And so that's one of the things that you have to do your due diligence and understand the sponsors with the deals that you're investing in, because they make all the decisions. So they need to be darn good at what they're doing, have a great track record, and then also have experience in management of that type of asset. And so that's one of the things that you want to understand, because you can't decide on the paint colors, on who they're going to lease to, or when they're going to sell the building. You're going along for the ride, and it's 100% passive. And so that's the thing that you have to realize. You have to be zero control. You have to be comfortable with that and understand that, where you're giving up and you're lowering your risk profile, but you got to understand that you're going to lose some control with going through that. But that's okay, because that's why you have a diversified approach. You don't ever put all your eggs in your basket, and you have a holistic plan that focuses on everything that you're doing with this single real estate investment. And then the fees and risks, because there are also fees that are associated with DSTs. When you start looking at how everything is set up, just like with any real estate transaction, there are risks of property underperformance, market shifts that happen, and various fees at different stages of the investment that you have to look at. And that's why it's critical that you're not rushed, and you actually have time to go through and understand, how does this serve me, and how does this fit into my long-term financial plan. And if you don't have a financial plan, you don't have a strategy for your finances and for your real estate portfolio, and know how you're going to exit active real estate management, then we definitely need to have a conversation. And then I'll say the last one, that you want to definitely have a really firm approach and understanding of, is your suitability. That, generally these DSTs, they're reserved for accredited investors that have a high net worth of over $1 million, not counting their primary residence, or they make, as a single individual, at least $200,000 a year in annual income the last 2 years, and a reasonable expectation that they would make $200,000 in the upcoming year. Or as a couple, they make $300,000 a year for the last 2 years, and with a reasonable understanding that they'll make $300,000 this upcoming year. That's kind of the definition. That's dynamic. They're looking at, I know Congress has passed some things. They're looking at, being able to place a test to allow investors to get into these deals. So that's going to be great for more access, because, when you start looking across private equity, you look at private placements, that for decades and decades, that these type of investments have been reserved for the wealthy, hence the accredited investor designation, and allow you to invest and build wealth these type of investments. But then it goes back, that suitability. You want to make sure that you're with the private placements. As of today, you need to be an accredited investor. So with that, when you look across 1031 exchanges and DSTs, we're a little rushed, but we're going to continue to keep this conversation going. And if you want to, download my 1031 DST planning document here, definitely shoot me a message. Would love to give that to you. And if you want to have a conversation, if you're looking at exiting real estate and you're tired of the tenants, toilets, and trash, then let's have a conversation on some different strategies to put together for yourself on how you can exit real estate smartly and buy back your time. One of the things that my goal when I left the Air Force after 20 years was to have a real estate portfolio that could serve me. and I not serving. And so that was one of the things why that pushed me into commercial real estate. But even with commercial real estate, there's levels to being able to do value add strategies, but then also buying more class A opportunities. But then one of the great things that I've learned is with private placements with institutions, with large institutional deals that are buying, billions of dollars of real estate and managing them, that have Harvard degrees and portfolio managers. And there's a sophistication, a level of the execution that you won't necessarily gain at the lower level with you self-managing. And so that's one thing that I've definitely gained appreciation for. And so one of the things that you really want to understand and going through with 1031s and DSTs is you want to look at what's your current income. Is the property producing what you need right now with the property? Maybe it's time to sell. And if you're looking to liquidate and you're looking to defer those capital gains where all the wealth you've accumulated in real estate over the decades, and now you have to give the government 20 to 30%, maybe you should look at doing a 1031 exchange into a DST where you can be more passive, have institutional management, and kind of step into retirement and set up a strategy on how you can build your comprehensive financial plan into retirement as a real estate investor. And that's what I'm here for, to help you guys make that transition. And then, just really understand, are you tired of active management? Because it gets old at some point. And I would tell you, once you have that time freedom and the ability to do what you want with who you want to, whenever you want to, for however long you want to, it's hard to go back from that. And so that's one thing that we really work with, and why I love working with clients that are doing 1031 exchanges and looking to get out of active management and move into more institutional deals, is because you can see the burden that's lifted off their shoulders when they go into these institutional deals, and it gives them a peace of mind and it gives them their time back, because it's a grind. It is a grind being an active manager, a landlord, with the projects, the turnover, the tenants, the complaints, the dealing with the lawsuits. Dealing with just all the challenges that come with being a landlord, that a lot of times you just don't realize the burden that comes with it. And so for a lot of investors, it's a challenge, and they paid their dues and they're ready to go, and they don't want to give the government 20 to 30% just because they have to. And so if that's you're in that position, would love to have a conversation. Or if you're a CPA or attorney or a qualified intermediary, you have clients that are struggling with transitioning out of active management, I would love to have a conversation with them and build a suitable plan and strategy to help them move into more institutional passive opportunities that are out there, and to give them back their time that they can spend with their loved ones and do whatever it is that they want to do. And really, I think for the big one is really the risk, because, when you start looking at 1031 exchange and you're moving all your assets, especially, if you are looking to retire in the next 5-10 years and you're moving all your real estate capital gains into one asset, that's extremely risky. What if you're buying someone else's problem? What if you're buying, a lipstick pig with a lipstick on it? That you're getting into a lot of risk with taking on a bad asset because you're hurried by a 45-day rule. And so don't let that be you. Make sure that you have a strategy that's serving you for the next 5, 10, 15, 20 years, and not just making a haphazard decision because you're on a 45-day rule with everything that you're built over the last 10, 20, 30 years. And you're putting it all into one asset that may work out, maybe not. And you only have 45 days to kind of identify that. So we'd love to have those conversations. I'm Johnny Lineup. This is the Deal Makers Club, unique episode today, just because we didn't have a guest, but be on the lookout. I have some great, phenomenal guests that are coming up here in the next couple of weeks. I know one of the big ones that we're going to have coming up here in the next 2 weeks is looking at the music industry and looking at investments in IP and looking at the intellectual property that comes with the music industries and how unique companies are positioning to buy music rights. And we just see it all the way. There's Justin Bieber, T-Pain, just sold his music rights. I think Future, and then there's other artists out there. So that's one that's coming up. And then we're just continuing to talk through all these situations that are allowing accredited investors to build wealth smartly. I'm Johnny Lineham. This has been the Deal Makers Club. I'll see you on the next show. Let's go. Let's make some equity happen together.